Hi everyone, today I'm going to talk about what to do in a rising rate environment. Now, the effects of rising rates or on real estate specifically, right? Here are the things that we have to cover. First of all, when rates go up, okay, if you are doing room rentals, your cash flow actually drops because you call it co-living in Singapore, you call it HMO in UK, whatever it is, because you're covering the utilities, okay, generally cash flow falls. Now, return on equity actually falls because borrowing costs actually rise. Now, for example, say you need to buy a house, right? That's say £250,000. Yes, you can buy a house for £250,000 in UK, even in fact a semi-detached in Birmingham. That's not a problem. Now, okay, say the rental yield, okay, the total cost including taxes, 5% for taxes, and then maybe 1% for legal, survey, a light refurb, maybe you add 10% on it. So the total cost is 275,000. Okay. Now, let's say the rental is net is 5% net. All right. So it will be 0.05 times 275K, right? This is going to be a net rental. So let me calculate that. Okay. So 275 times 0.05, you're going to get 13,750, okay, per year. Now, your margin is 80%. So your net is 80% times 13,750. Okay, what you get is 0.8 times 13,750. You get £11,000 net rental. Now, if you take a 75% loan to value ratio on the purchase price of 250,000, okay, you still have to get, so your mortgage is times 250,000, that's 187,500. Okay, if previously the interest rates were 3.5%, okay, it is if it's an interest only mortgage times this, you're going to pay 6,562.5. Yeah. So your net income, 13,750 minus 6,563, okay, 6,563 is 7,187. Not bad, right? So 7,187, you divide by the money left behind. How much did you spend? 275,000 minus your loan, 187,500. We're actually 275,000 minus 187,500 is actually 87,005. So your net profit based on rental alone is 7,187. 7,187 divided by 87,500 money left behind, right? Divide by 87,500. It's actually 8.2. That's higher than REITs, isn't it? Right? Per year, just on rental income alone. Okay. Now, what if the interest rate now goes up to 2 percentage points, 5.5%? Okay. Now, what's your new rate? 0.055 times 187,500 is actually 10,312.5. So what's your new number? 13,750 minus 10,312.5. What are you going to end up with? What kind of profit are you going to end up with? 13,750. It's only 3,438, right? Rounding up. So you have a measly profit of 3,438 because of 2 percentage points increase. And what's your return on equity? 3,438. Now divide by 87,500. you're going to end up with a number of 87,500. You end up the number of 3.9% on rental alone. So 3.9 versus 8.2. Suddenly it turns out to be not so good, right? And worse, if the interest rate goes up another 1%, I think, or 1.5%, say 7%, that's the end of your returns. Okay, so this explains a lot. So it's a deal breaker. It kills a lot of deals. So do you want to do it when now it's 3% return on the rental alone, or 8%? So a lot of deals that previously made it looks good, now don't look good. So return on equity actually falls. I answered 2 questions, right? So demand actually slows, economic recession follows, right? Because higher rates, what's the purpose of having higher rates? Higher interest rates actually pushes down demand so that people will hire less. You actually cause unemployment because employers start to feel that, you know, it's quite expensive to expand because you need to borrow money, and the interest rate has gone up, and so why expand? So hire less people, fire them, stuff like that. So real estate demand actually softens, drops as affordability drops. Now, there are several types of people that is going to be badly hit. Okay, what are they? First of all, homeowners. Number one, I think the most vulnerable. Surprise, surprise. Let's give you an example in Singapore. You have a $2 million condo. Okay, or better still, I give you a 3.5 million landed house in Singapore, 3.5. Okay, you put in $1 million deposit. Okay, now you have to borrow 2.5 million, and in Singapore it's principal plus interest repayment. So let's say, okay, your repayment was actually 1.5% and it's going to be 3% higher. Now, how much interest are you going to pay? Okay, let alone amortization, 2.5 million, okay, times the differential of 1.5%, you're actually paying 37,500 extra in interest. Just on interest alone, divide by 12, right? Is 3,125. Okay, increase if the interest rate goes from 1.5 to 3. So what happens? I would say that if a couple in a family, you have husband, wife, assuming, right, and 2 to 3 kids. Okay, now if both are working, great. The average income in Singapore, say, is $6,000. So if both are working, disposal 12,000, say, okay, another tax is about $2,000, so $10,000 net income, right? This 2.5 million, right, is already roughly about 8,000, you know, principal plus interest repayment. And if I increase another 3,125, you're actually paying 11,125. The normal family cannot afford. Okay, so I think they will have to sell. So homeowners have a big problem. Number 2, if of course if you don't have a mortgage, that's fine. But if you have a mortgage, anything more than 2 to 3 million, and you are fully stretched, it's going to hit very hard on this homeowners. Okay, now the second group is investors. Investors, if you have 75% LTV, right, and your rental, let's say overseas, in United States, you can get as high as 5 to 7% rental, net, UK as well, and the mortgage could be 4 to 6%. I think you're fine. You're going to be, your cash flow is just going to drop, okay, almost to break even or slight profit, you know. Then there are ways to solve this problem, right, for investors. But I think what I'm trying to say is that surprisingly, it may hit homeowners, especially if one person lose their job. But investors, right, if you're 90% geared, it is quite dangerous. Now, if you're 75% geared, I think it's okay. Now, if the cash flow actually drops, what you can do is that you keep more cash on the side. That's why I have a portfolio of stocks as well. Okay, like I said, or you have a big pool of properties. Let's say you have 14 properties. and then some of it is lower geared, 70%. Some of it is higher geared, 80. Some of it you did not refinance, you did not remortgage. After a while, the equity actually builds. So you keep it at 60%, you will have some reserves. Okay, that's enough. Next, focus on three things. How are you going to resolve the problem? Continue to buy. I would say, right, property is quite a little bit different from stocks. As the property market reaches the peak, okay, even if it comes down, you can always buy one a year. Okay, 10 property in 10 years. But it must meet the requirements. So for me, the return on equity is very important. It must be positive, okay? At least, I would feel that it should at least be 6%. And the return on invested capital must be greater than 15%. What do I mean by return on invested capital? Okay, in real estate terms, right, it is actually your net profit from the rental, okay, plus the first year capital appreciation, okay, divide by the down payment, okay, it must be, as long as they fulfill this criteria, continue to buy. Now, let me go back to this example here, okay. Going back to the example that you have a down payment, 87,500 left in the deal, okay. If you had a 5%, 6% rental yield, net rental yield, right? Okay. And let's say 5% interest rates, right? So your mortgage is 187,500, okay? 0.05 times 187,500 gives you 9,375, okay? And 6% of the purchase price is 250,000. Going back there, 0.06 times 250 is equals to 15,000. Now, don't forget, you need to pay agents to maintain it, voids and all that. So times 80%, you are roughly going to get times 0.8, 15,000 times 0.8 is going to be 12,000, right? 12,000. Now, you minus off this 9,375. 375 is 2,625. Okay, that's your net profit. Now, what's a typical capital appreciation in UK? If you buy a house, is semi-detached, is usually about, well, a terrace is about 5.5, depending on where, if you're on the south or the north. And if you have semi-detached, it's probably 6.5. Okay, let's choose 6.5%. So if it's 6.5% capital appreciation, all right, let's be more conservative. Let's do 5%. Okay, even though the Domesday Book over 1,000 years, records, believe me or not, records have been kept in UK for over 1,000 years. Okay, property prices actually double every 10 years. So the rule of 72, right, tells you that it must have capital appreciated by 7.2% over 1,000 years, right? So there's a lot of history behind it. So let's say 5% capital appreciation. You're going to get a number of 12,005. 12,005. Now, capital gains of 12,005 plus what's your net profit? 2,625. Okay. 15,125. Divide by the amount that you left behind, 87,000. 15,125 divide by 87,500. 15,125 divide by 87,500 equals to 17.3%. Okay, so your ROIC is above 17.3%. Go for it, man. Go for it. So The other thing about the is volatility is an opportunity, right? Unlike stock markets, it goes up, it goes up, it goes down, it goes up, as we all know, right? It comes down again, right? Property is quite smooth. It just goes this way. Any kind of a dip is great. So we talk about the two groups, right? That there are owners, and those are overly geared. Whether you are investor or homeowners, it's going to be a big issue. I feel that if you are homeowners, it's quite vulnerable. You don't have any income, so it pays to be an investor. So volatility is an opportunity actually. As long as the deal passes the requirement, go for it. Okay, but don't stretch yourself to say that the deal ROIC is only 10%, ROE is only 1%. Oh, hey, I want to make it work just because I got to buy. You got to be very disciplined. So in UK and US, supply is really an issue. Okay, you notice all the countries with very tall buildings, okay, skyscraper, or that there's a sign of supply. I don't care what kind of master plan that's written. No, master plan means new builds. Okay, new competition. If you're a homeowner, you don't want to see more flats or condos next to you. You just want to see more shops, so that more people want to live in the area, right? You don't want to see more apartments. But in UK, US, right, generally they don't have that many new builds. You notice a city, right? The higher the taller the buildings, the lower the capital appreciation. I kid you not. So doesn't mean that Singapore is very tiny island. The supply is very limited. Oh man, I can build up in the sky, infinite. Okay, so there's also a joke, right? Or it's actually not a joke, that if a city or country builds the tallest tower, right, chances are there's going to be a recession. Look at Dubai. So I'm saying that in UK, US, generally there's a lot of upside because supply really is a huge issue. They're not building enough. Look at your net operating income. Really, there's less margin forever. Don't overpay. Estimate your rental income properly. Go through the steps that we're going to teach you in your courses as well. Okay. Now, how not to overpay and what's your margin of error? It is very important to estimate your rental properly. Okay, and pay market price, not or below market. Do not go and overpay. Right? So you need to estimate your income. So go through our steps. One of the steps is ROIC that I look at. So let me give you an example, right? Do not overpay, right? Take, for example, this project, Manchester 360. Okay, I calculated, pardon the poor handwriting here, 1 bedroom, okay, is 415 PSF. Okay, 2 bedroom, 344 PSF per square foot. 3 bedroom, 417 PSF. It's a very good area. Look for the postcodes. Okay, look for the M15 4AX. Okay, it's the postcode here. So when you see this, right, 1 bedroom is 575 to 582 square feet. 858, 2 bedroom is 858 to 1058. 1137 is 122, 1137 to 1224. Guess what type of bedrooms should you buy? Okay, if you have 1 bed to 2 bed, is usually the worst. These are all what the investors buy. If imagine you have tenant, imagine it's a single, okay, stay in a 1 bed. If you got married, you got a partner, what happens? 1 bed suddenly is too small. So so he goes to 2 bed. And if it's and they get married, they have kids, so it's a 2 bed sufficient? No, it becomes 3 bed. And you have 2 kids, a dog, pets, 4 beds. So that's why I said, right, 3 to 4 beds are the best. Okay, sometimes even 5 beds. Okay, so you go to Rightmove. Remember the postcode. Okay, every country has their own property guru, Rightmove, Zoopla, Zillow in US, M15 4AX. Okay, for sale. Right, so now you put 1/4 mile. Okay, put 3 bedrooms. Okay, property type, you put apartments. So there are, let's put here, right? We have chosen 3 beds, okay, M15. So you choose the lowest to the highest price. Well, this is a historic building. I'm looking through here, right? St. George. Okay, 3 beds. Yeah, 43. This is an apartment, right? How big is this? Wow, it's 1367 square feet. Historic apartment, right? Oh, so the average in property data, 289 per square feet. Okay. In this case, 1367. Let's look through the photos. This is a conversion. Very nice open space. Okay. 1367. Okay, going back here. 1367. So 345,000 divided by 1367. What do you get? 252 PSF. 252 PSF. Now going back to here, right? What's the number? You're paying 417 versus 252. You're actually 417 divided by 252. You're actually paying 65% premium. Can you see it? Now you want to know what is a true rental, right? Go back to for rent. Okay. A quarter mile radius M154AX, right? Postcode. 3 beds. Not bad. There are only 14 for rent. Okay, 14 for rent. So you take the midpoint. Okay, sort from the lowest to the highest. 3 bed. Okay, 14 for rent. Let's look at the midpoint. So there are 14,117. You're likely to get about 2004. How's that for a new home? Okay, 2,400. That's how you estimate. Maybe give it a discount, 2003. Now, if you choose 2 bed for rents, okay, look at how many are available. 107, no, my friend. 107 for rent. That is a lot compared to 3 beds, right? It just is so few now, right? 3 beds, they're only 14. Okay, how about 4 beds? They're very rare. But I'm sure there are families that want 4 beds. But families, when you have that, then you would rather, if you have a family, you rather have a house. So when it comes to 3, 4 beds, they rather have a house. There are only 2 for rent. I'll show you something, right? Go back to this. Okay, quarter mile. Okay, let's look at half a mile. Okay, 3 bed rooms, right? Flats as little as 230. Look at this, Riverside Derwent, 230,000, right? How much per square foot is it? Now look at this size. I shall look through these are all ready built apartments that are available for rent from day one. Rather than you buy something from a developer, you get nothing in 2 years' time. It could be up, it could be down. Most likely the valuation might even be down value. I mean, it's down value, you cannot get a mortgage. Okay, let's say you bought at 400,000, end up to be 300, then you can get a mortgage only 200,000, and you got to put the deposit of 200. That's a lot. So this is completed. You can actually inspect. Okay, look at the size, 776 square feet. Okay, asking 230. Let's look at the square footage per square foot. 230 divided by 776. What do you get? 296 pounds PSF. Was 417 PSF, and we are paying 296. Okay, 417. We are paying 296 here. How big a discount? 417. Wow. Yeah, 29% discount, right? So let me show you something else. Why buy a house? Why buy a flat? Why don't you just buy a house? So let me show you this. Let me show you this. Look at this. This is an older terrace, right? no less, end of terrace, Hume. Okay, look at this, 275, this is a bit bigger. Okay. I'm sure this is nice. This has got a very nice street, got a garden at the back, ready-made, 275, a nice small little garden. Okay. Let's look at how big it is. It's 1048. 1048. Okay. So how much are they selling for? 275. 275. 1048. Is it 262 pounds PSF? Very nice, right? Rented at 1645. 1645. Okay. Floor plan shows bedroom 1, 2, 2 bathroom, very nice. 3, 1 4 bedrooms, very good. 4 bedrooms, 2 bathroom and 1 toilet, very good proportions. Very good proportions, right? Open the map. You want to know where it is? I bet you the location is pretty good. Look at what's nearby. Very near the city center, Hyatt Regency. This is the city center already. I bet you it's a walking distance, right? Back to here, you can even walk the streets of the place and get a feel of what kind of place it is, right? Take a walk around. We don't have time for this, but look at this. This is beautiful. 1 lane highways, you know, not very heavy traffic. Yeah. And Manchester, I think they got parking at the side, gated parking. So it depends. Okay. So you can even check what kind of people are staying there. M15. All right. So for example, street check, you can see the type of people by looking at this housing. Okay. A lot of private rented, owner occupied, owner in mortgage, a lot of private landlords. So it's a big rental market, right? But mainly white collar, ABC1. So pretty okay area, right? So remember what it said here, the numbers. Okay, 1645, 275. Already you're much cheaper than whatever you bought, right? If you buy from developer. So let's say you do your calculations. What's your return gonna be? Okay. Let's do our sums. 275,000 purchase price. Okay. Add a little bit of repairs, refurb, furnishing, 275,000. You're gonna have 5% tax. Okay. It's gonna be 13,750. You're gonna have 5,000 of furniture, most likely. Let's say there's a light refurb furniture. Slight repairs, refurb, touch up, right? And then legals, maybe 1,000, right? Legals and surveys. So total, what do you pay for it? 300,750. You can call it gross development charge or whatever total purchase, including all costs, right? So 1645 times 12. Now 19,740 times 80% margin, right? So times 0.8, 15,792. Okay, so let's say you get a mortgage for 275. So what is your rent, net rent without leverage? 5.25. 275 mortgage times 0.75, you're going to put in 206, you're going to have a mortgage of 206,250. Okay, 75%. Okay, how much money is left behind? 300,750 minus 206,250 equals to 394,000 in. Right, so what's the interest rate? So assume you got to pay 5% now, interest. 206,250, okay, is 0.05 times 10,000, 312.50, okay. So your net profit after mortgage, $54780. 5480. What's your RO return on equity? 5480, 94,500 divided by 94,500 is 5.7%, 5.7, 5.8%. Is that good enough? Now, this is your ROE. Now, not forgetting, right? Property price, let's say, appreciates 5% a year. 5% a year times 275,000. You want to know what's the ROIC? 275 times 0.05, 13,000. You're going to get this 750. So total will be 5480 plus 13,750 gives you 19,230. Okay, divide by money left behind. What's 19,230 divided by 94,500? Okay, what does that give you? Divide by 94,500, it gives you 20.35% ROIC. Do you see that? So voila, there goes. So you do have a much better return. You can actually buy a house in Manchester and do quite all right. Cheaper than a new build apartment that you buy from developer. So there you have it. And going back to my lessons that I've drawn up, number one, right? Don't stop buying. As long as the ROIC you can find above 15%, return on equity is above 5%, go ahead and buy it. Okay, you still need to buy one a year. Okay, you need to survive a crash. Make sure that the supply is very little and the demand is a lot. Okay, you don't want to buy apartments at 2 beds. And so net operating income. Number two, net operating income has to be correctly estimated, rental, and don't overpay. Now, in the end of all your check, in the course, we're going to teach you how to do all the checks. At the end of the day, we have the power team to look for various major cities in UK. So trusted people will be on the ground to take videos, look at it on the day and night, things like rubbish, graffiti, neighbors, all this play a part. So we can complete it and you don't even need to view the place before you buy, right? Of course, then eventually when you have time, fly over there, take a look at it, should be fine, right? So we had a team to manage the tenants for you as well. So there you go. So don't worry about interest rate rise. You got to be very disciplined, make sure that it's cash flow positive, capital gains in the right city, right location. Don't overpay for it. Estimate your rental income properly and don't stop buying.